250 points. That's the entire range of the Nikkei 225 over the past 48 hours, from 59,840 down to 59,400 back. Meanwhile, US dollar to Japanese yen crashed 300 pips, then bounced, and the Nikkei barely reacted. Is this calm before the storm, or is the Japanese market quietly decoupling from the yen? In the next 12 minutes, I'm giving you 3 exact trade setups on Nikkei futures: a conservative range trade, a breakdown continuation, and an aggressive reversal. And because this index lives and dies with the yen, I'll show you exactly how to use US dollar to Japanese yen as your trigger. Stick with me. What's going on, alpha traders? This is the meridian, where we trade the connection, not just the chart. Today is May 7th, 2026. And we are covering Nikkei 225 right after US dollar to Japanese yen because the two are intimately linked. Current Nikkei cash index is 59,513. The futures are trading at 59,520. The high from yesterday was 59,840. The low 59,400. We are sitting exactly in the middle of a 2-week range. Here is my conclusion straight up. The trend on Nikkei is neutral to slightly bearish below 60,000. We have a clear range between 59,400 and 59,800. A break of 59,400 with US dollar to Japanese yen below 155.50 would target 58,400. A break above 60,000 would re-engage the bull trend. But right now, the probabilities favor range continuation with a downside bias because the yen is showing strength. Open your charts. Let me walk you through the structure on Nikkei 225 continuous futures. On the daily time frame, the picture is clear. Price has been oscillating between 59,400 and 59,800 for 10 trading days. The daily MA5 is at 59,580, MA10 at 59,521, MA20 at 59,554. All three are virtually flat and tangled. That's a classic compression pattern. The daily MA40 is at 59,743, slightly above price, acting as resistance. The daily MA60 is at 59,581, almost exactly where we are now. So we are sitting right on top of the 60-day average. A close below 59,400 would put us below all these short-term Rs. Look at the daily MACD. The histogram is negative at minus 436.94, but the fast line is just below the slow line, a weak bearish signal. No real momentum yet. The daily RSI is 47.48, dead neutral. This is not a trending market. This is a waiting market. Now zoom into the 4-hour chart. This is where the range becomes visible. You see a series of lower highs and higher lows, a symmetrical triangle or a flat range. The 4-hour MA20 is at 59,570, MA40 at 59,580, MA60 at 59,590, all clustered. The 4-hour RSI is 51.2, exactly neutral. The 4-hour MACD is flat around zero. No edge from momentum. The 60-minute chart gives us the execution levels. Resistance is at 59,800, the top of the range, then 60,000, psychological. Support is at 59,400, range low, then a major level at 58,800, previous breakout point, and then 58,400, daily MA200 zone. Key levels, write these down. Immediate support, 59,400. Next support, 58,800. Immediate resistance, 59,800. Next resistance, 60,000. A daily close below 59,400 opens. The door to 58,400. A daily close above 60,000 target 61,000. Now, why is Nikkei trapped, and how does US dollar to Japanese yen fit in? First, the yen correlation is still intact but weaker than usual. US dollar to Japanese yen fell from 157.90 to 155.02, a 2.8% move. Historically, that would drag Nikkei down 1.5 to 2%, or roughly 900 to 1,200 points. But Nikkei only dropped about 400 points from its high. Why? Because Japanese corporations have hedged their dollar exposure better than in previous cycles. The correlation is still positive, but the beta has shrunk. That means a move in US dollar to Japanese yen no longer gives you a one-to-one trade on Nikkei. You need confirmation. Second, institutional positioning. According to the latest Tokyo Exchange data, foreign investors were net buyers of Japanese equities last week, but only barely. The net long position in Nikkei futures is at the 55th percentile, neutral. There's no crowding, which means no forced unwind. That's why the range is holding. Third, BOJ policy expectations. The market now expects the Bank of Japan to raise rates again in July by 10 basis points. That's a small move, but it's enough to keep the yen supported. If US dollar to Japanese yen breaks below 155.00, that would be the trigger for Nikkei to break 59,400. Fourth, global risk sentiment. The S&P 500 is also range-bound, and the VIX is low. Without a catalyst, Nikkei will stay in this range. Now, how to use US dollar to Japanese yen as your leading indicator for Nikkei. Watch two levels, 155.00 and 157.00 on US dollar to Japanese yen. If US dollar to Japanese yen breaks below 155.00, expect Nikkei to accelerate lower to 58,400. If US dollar to Japanese yen rallies above 157.00, expect Nikkei to test 60,000. Between those levels, the range holds. The 1 to 2 week view? Neutral to bearish, range 59,000 to 60,000. A break below 59,400 targets 58,400. Now let's turn this into 3 actionable trades on Nikkei 225 futures or CFDs. Strategy 1, conservative, range mean reversion. This is for traders who like high probability, low stress setups. Entry condition. Wait for price to reach 59,800, range high, with a bearish rejection candle on the 60-minute chart. Enter short when price closes below 59,750. Stop loss. Above 59,950, just below 60,000. Risk. About 200 points. Take profit 1. 59,450, 1.7 to 1. Take profit 2. 59,400, 2 to 1. Invalidation. A daily close above 60,000. Then the range is broken. Strategy 2, standard, break of 59,400 continuation. This is my preferred setup for the next few days. Entry condition. Wait for a daily close below 59,400. Do not chase intraday breaks, they often fake out. Enter short on a retest of 59,400 on the 60-minute chart. Stop loss. 59,650, 250 points above entry. Risk. 250 points. Take profit 1. 58,800, 2.4 to 1. Take profit 2. 58,400, 4 to 1. Management rule. Once price hits 58,800, move stop to break even and let the second half ride to 58,400. Strategy 3, aggressive, breakout fade, high risk. This is only for professionals. Do not try this if you are new to futures. Scenario. Nikkei drops to 59,400 but does not close below. Instead, it shows a bullish divergence on the 60-minute MACD, price makes equal low, MACD makes higher low. And US dollar to Japanese yen holds above 155.00. Entry, long at 59,420 after a bullish rejection candle. Stop loss, tight at 59,200, 220 points below. Take profit 1, 59,800. Take profit 2, 60,200. Warning. This is a counter-trend trade within a neutral range. If price closes below 59,200, cover immediately and consider shorting. I will be taking strategy 2, selling the break of 59,400, because it aligns with the yen strength narrative and offers excellent risk to reward. Before you touch any Nikkei trade, remember, futures can gap. Overnight gaps of 200 to 300 points are common. especially after US economic data or BOJ comments. That means your stop loss might not be honored if you're using a simple stop. Consider using options or smaller contract sizes. Do not risk more than 1% of your account on a single trade. For a 250-point stop, that means one mini contract per $25,000 of account capital. Also, never hold a Nikkei futures position into a Bank of Japan policy announcement. The volatility is extreme. Now I want to hear from you. Scroll down to the comments and type, Nikkei, will 59,400 hold or break this week? And tell me your favorite correlation trade. The comments section is our daily war room. Let me wrap today's Nikkei 225 analysis into 2 sentences. We are in a range between 59,400 and 59,800. The bias is slightly bearish because the yen is strong, but the real trade is waiting for a break of either side. Do not trade the middle. Be patient. Tomorrow, we are covering gold and WTI crude oil as a pair because both are responding to the same inflation and geopolitical narrative. Gold is testing $2,350, and oil is stuck under $80. That episode will give you a complete commodity hedge strategy. Do not miss it. If this analysis added value to your trading, hit the like button. Subscribe and turn on notifications so you get every video the moment it goes live. This is the Meridian. Stay disciplined, stay data-driven, and I will see you on the next candle.